All right, it is 4 minutes after, so we're going to go ahead and get started. Thank you for your patience, everyone. Welcome to today's session. Thank you for joining us. I am Corey Norpel, and I'm the Operations Director here at Chastain Wealth Management. We have a lot to cover about Biden's tax proposal, so we're going to record this and send this out to our attendees, so you will have that to revisit at a later time. There will be time at the end for questions. So go ahead and use that Q&A feature and we will address those after the presentations. To start, I'd like to introduce you to today's official host and one of today's speakers, Larren Odom. Larren is a certified financial planner and the founder of Chastain Wealth Management, which is a virtual family office here in Sandy Springs. He has been in the industry for more than 20 years and has helped hundreds of clients protect and grow their wealth. He's received his MBA from Georgia State University, and more personally, he also lives in Sandy Springs with his wife and their 3 children. Jen, his wife, is actually a litigation attorney at Bryan Cave Law Firm. So that is a little bit about him. With that, here's Larren.
Thank you so much, Corey. Really appreciate that and appreciate everyone attending today. We are going to try to be very brief as we advertised in our email. We're going to try to keep it to around 25 minutes, and we're going to give you the top 3 things that we think you should know. There's a lot that's been proposed, but we're going to try to highlight the high level stuff. So I'm really pleased to have 2 members of our virtual family office team, Kim Hoipkemier and Jeremy Bird. Kim is the partner and owner of Georgia Estate Planning and Probate, and has a lot of experience dealing with estate plans in different levels. And Jeremy Bird is the Senior Vice President at Arthur J. Gallagher and is an insurance expert, especially as it relates to transferring and protecting wealth. So we're thrilled to have both of them here. Just real quickly, as Corey mentioned, I am part of a fantastic team, the Chastain Wealth Management Virtual Family Office. It's made up of a group of professionals in the estate planning, asset protection, investment world, all in their own firms, but just we have a really tight-knit group that we work together to solve our clients' wealth transfer and protection problems. So thrilled to have 2 members of our team here today. So the reason for this webinar is that changes to the way your wealth is taxed and transferred are imminent. We don't know for sure what's going to happen, but something's going to happen. The Democrats control all 3 houses of government, the relevant houses, and so they are going to change the way that wealth is transferred and taxed. And we want to make our clients and prospects and friends aware of that, and then offer some potential solutions that could help minimize that. So with that, I'm going to turn it over to Kim, who is going to talk about the first most important thing that you need to know about the tax changes, and that is the potential change in the federal estate tax. Kim, please take it away.
I will. Thank you, Larren. I sincerely appreciate you having me here today. And Biden's proposed changes are numerous, so we're hitting the highlights today. First one I want to mention is federal estate taxes. Those are the taxes that may be assessed at your passing if you have assets over what we call an exemption. So everybody gets a certain number of assets that are not taxable, and then if you have net worth over that amount, then federal estate taxes are assessed at death. The current exemption, or how much net worth you may have at death before taxes become an issue, is $11.7 million per person. This is a holdover from a Trump tax plan. So lots of wealth can be passed now tax-free. It's a married couple has $23 million worth of net worth, and then any assets over that amount would be taxed at a 40% tax rate. The scheduled change, though, what I want to highlight is the potential changes to those numbers. The scheduled change is that this law will expire in 2025. So at the end of 2025, our exemption will automatically drop to $5 million per person. That number may change a little bit as it is indexed for inflation, but the tax rate jumps up to 45%. What could happen even sooner than that is part of Biden's tax plan, either to roll back to that $5 million number sooner than 2025, potentially raise the tax rate before that happens. So what we're seeing is a lot more clients that are potentially subject to estate taxes as these exemption numbers come down. I want to highlight as well that estate tax is due and payable to the IRS within 9 months of death. There are no exceptions to that rule. You can extend the filing of the tax return, but you've still got to pay the estimated estate taxes within 9 months. What we have found is that can be a pretty big financial burden for families with illiquid wealth. So a family that has a family-run business or significant real estate holdings, we're looking at selling off assets in order to pay that federal estate tax. I'll mention one client family here as kind of an example for you. We'll call them the Smith family, but they owned a winery, not their real name. And they owned a winery in the North Georgia area. Land had been in the family for a number of generations, but in the last, like mom and dad's generation, had really built it up into a fairly profitable bed and breakfast and winery organization. So dad died rather unexpectedly in 2008. He had what we refer to in estate planning world as an I love you will. So I give everything to my wife, and if my wife doesn't survive me, I give it to my kids. Certainly there's a time and a place for an I love you will, but with a bit more planning, as you'll see, he could have benefited from a bit of planning. So the I love you will gave all of his interest in the winery and the land to his wife. She continued to live and grow the company with the help of her adult children over the next few years. She passed in 2015. In 2015, we had an estate tax exemption of $5.4 million. So still plenty of exemption there, but we hadn't used any of dad's exemption back in 2008. So now all of the marital net worth was subject to a 5.4 exemption from estate taxes, meaning anything over that was subject to a tax at a 40% rate. Adding up all of their net worth, we had about a $10 million winery value. We had other assets, personal residence, some insurance, some retirement accounts. Total net worth was somewhere in the neighborhood of 14 million. Taking away that $5 million exemption left them a tax bill of 3.4 million. I feel like, and I'll show you some possible solutions to this, but the family really had to come out of pocket to pay for that estate tax. We ended up selling a vacation property and actually borrowing a little bit from the bank on a line of credit in order to pay those estate taxes. So I'm going to move on to the next slide, and I'll show you some possible solutions, how we can avoid that $3.4 million tax bill that comes at 9 months after somebody has passed. Kind of the key takeaway from today is going to be act now. We've got a lot of flexibility with some techniques that are currently available in this tax year. I'll start with the core estate documents. I mentioned my clients' I love you wills. But wills can be much more than that. We can do some pretty significant estate tax planning techniques within the will itself by using trusts to capture both spouses' exemption. So it may seem remedial as far as this presentation is concerned, but I always want to highlight, get good wills, powers of attorney, and healthcare directives in place. Other techniques that are available this year, we can gift that large exemption that we currently have to trusts. Trusts can fit all sorts of different client needs. We call it the alphabet soup of trust. So each one is kind of tailored to the client's specific needs and family situations. But all of that is part of estate planning. And the goal there is to reduce taxes and keep family assets intact. I mean, that's our job as estate planners. Probably the most significant and easiest technique to use, though, is life insurance. Something that we can certainly do to have quick, less expensive liquidity to cover estate taxes. Going back to my Smith family, let's say they had a life insurance policy in place, but either a single life policy or a second to die policy that paid out at the death of the second spouse. We could have used that quick liquidity to pay our estate tax bill without having to use those family assets, sell the vacation home, get the loan, for example. So, you know, it's not a fit for everybody. Each of these trusts is not going to be a fit for everybody, but the important thing is to analyze your situation, have a meeting with these folks, and see what works for you guys.
Great. Thank you so much, Kim. So with that, we're going to go ahead and turn it over. It's a good transition point to talk about life insurance. And our expert in that field is Jeremy Bird. So Jeremy, please tell us about how we can use life insurance to help minimize taxation on estates.
Thanks, Larren and Kim. Appreciate that. There is, in Kim's example, one of the obvious solutions would be to purchase life insurance inside of a trust. What that does, whether it's permanent or term, is going to keep the benefit payable upon death of either the single or both the second insured outside of the estate. So the beneficiary would also be the trust that owns the contract. The death benefit comes over income tax free regardless. But in order to keep it outside of the estate and provide the liquidity to the heirs of the estate to pay those estate taxes, you would want it to be trust owned. So that is a super common life insurance for estate planning 101 design. Never more important than today, given what the proposed changes are going to lay down. There are numerous types of ways to fund life insurance trust and or policy. Using personal funds, using existing cash values from permanent life insurance that you already have, doing 1035 exchanges is what that is called. There are no taxable events when you use existing cash values as future premium towards a new life insurance policy. There you can do third-party financing. You can even do interfamily private financing as well. Which funding method is best for you in your situation? We would determine that. But just understand that there are numerous ways to fund these contracts. And most importantly, for everyone listening, I mean, there's no cost for us to review your situation. Act now is kind of the overall goal and subject of this entire presentation. Be proactive, let everyone get involved, and take a look at your situation.
Excellent. Thank you so much, Jeremy. Yeah, I mean, just to put a fine point on that, you know, with talking to Kim and talking to Jeremy with our wine family, whose name is not Smith, you know, not only would they have not perhaps owed any estate tax, if they had owed any estate tax, they would not have had to take out a bank loan or sell property that they otherwise didn't want to sell with just doing some basic simple planning. So as Jeremy said, act now. Thank you so much. So with that, we'll move on to the second big point, which is individual income taxation and capital gains. Bottom line is income taxes on the wealthy, the people in the top income brackets, are going up. Right now, you know, it's proposed that anybody making over $400,000 or tax-free will go to 39.6% from about 3% less than that now. And then eliminating the Medicare tax loophole. I won't go into that, but there's a loophole around paying the 3% tax in Medicare, and that's proposed to be eliminated. So, you know, that's a significant amount, 6 or 7% increase in all that income on top of that you make over $400,000. There's some possible solutions. Again, these are all proposals. We don't know for sure, you know, which ones are going to pass. But there are all kind of solutions about where to put your income, potentially recognizing more income this year in anticipation of the income tax going up next year. And then, you know, some other strategies, making sure that 401ks and other assets are maxed out. And then the second large proposed change is the capital gains rate. So right now, the capital gains rate is either 15% or 20% for super high income earners over 441,000. The proposed change is to take that up to 40%. That's huge. That's double what it is now. So for example, if, you know, right now you bought an asset in 2000 for $100,000 and it worked, it grew, right? The asset, the investment paid off, and it's now worth $1 million. You've got a $900,000 gain, the 15% tax. on that $900,000 is, approximately $135,000, or maybe a little bit more if you're at the 20% rate. If this proposal goes through either this year or next year, you're looking at, more like a $360,000 gain on that, $360,000 tax, a $360,000 tax on that $900,000 gain. That's enormous. Really, really a huge, huge deal. The other big proposal is that right now, if you were to have that scenario and the example of $100,000 and it grew to $1 million, you got a $900,000 gain. If you were to pass that on to your heirs, this is completely separate from estate tax, just this single investment. You were to pass that on to your heirs would receive what's called a step up in basis. So the $100,000 investment that you made, that basis would now become $1 million. Whatever the investment was worth at the time of the owner's death, that now becomes the new basis, which essentially eliminates any of the capital gains. So that has been proposed to be removed. So if you were to pass on your wealth, that could possibly, your heirs could possibly incur huge taxes if this particular proposal goes through. So Corey made this slide and I love it. What's Bob Dylan got to do with it? Well, Bob Dylan had some good tax planners. So he had about a $300 million catalog of songs. That's what his songs were worth. And I don't know exactly what his basis was, but it was pretty small. A lot of his songs are from the 60s and 70s. So what he paid for those songs, or what the basis was pretty low. So back in 2019, in anticipation of some things like this happening, he went ahead and sold those at the 15% tax rate, right? Recognizing that things could have changed, which they did. So Bob was not only a great songwriter, he was a little bit of a fortune teller in this instance. Had he not done that, his gain could have been twice that. And obviously, with an asset like that, $300 million, you're talking about tens of millions of dollars, not hundreds, in savings that would go to the government rather than to Bob or Bob's heirs. And the third part, I'm going to turn it back over to Jeremy to talk a little bit about business taxation. So that's individual taxation. We want to talk a little bit about business taxation and some of the proposals there.
Thanks, Larren. Everyone under the proposed Biden plan, the corporate tax rate is to be increased from 21 to 28%. That's certainly significant. For corporate real estate investors, 1031 exchanges will be limited when gains exceed 500,000. Also, very significant change being proposed. Corporations with a book profit greater than 100 million could face a 15% minimum tax. These are real situations for any business owners. Again, to be determined what actually gets through and gets passed, but proactive planning now makes a lot of sense. Some possible solutions. Larren alluded this earlier from the individual front, but business owners could recognize more income today in preparation for these proposed changes. Most importantly is know what your business is worth. Most business owners have a pretty good idea. They think of what their business is worth. We can provide informal business valuations within a 5% approval variance from an IRS paid for valuation at no charge. It's a really neat, about 12, 13 page report that some of our carrier partners provide. So it's a great service, no obligation to do any work other than know informally what your business is valued at. And then lastly, what sort of succession plan as a business owner do you have in place? Is there an executed, which means signed, buy-sell agreement with yourself and the other business owners? What happens in the event of a death, disability, or retirement situation? Those are just three of many triggers in a typical buy-sell agreement. So act now. Again, that's the premise here.
Great. Thank you so much, Jeremy. Yeah, so, again, this is a high level look at your situation, and your situation is unique. What kind of cash flow you have. I wasn't involved in the wine family negotiate or planning, but I'm sure they had their own cash flow. The mom and dad, the kids had their own cash flow. Was there a buy-sell agreement in place? Did they know exactly what the business was worth? What was their current taxation? What was the taxation of the next generation? What was the desire of the heirs? Where did they want the winery to go? What did they, what were their specific plans? And so there's no way that we can give you a cookie cutter solution, because every single person is different. And, Kim put up a bunch of, she called it the alphabet soup of trusts. They all have pluses and minuses, but they're all tailored. They're all used extensively by different families, just depending on what they want, what that family wants. So really, it really does take a team of estate planners, CPAs, asset protection specialists, investment managers, to offer those customized solutions, to make sure that the plan that they put into place for you is correct. But I always like to tell people that, especially if you haven't done any estate planning, whatever you decide to do will be better than what you've got now, which is nothing. Doing nothing is a disaster waiting to happen. Paying taxes to governments, borrowing money to pay those taxes. So as Jeremy said, act now. One of the ways that you can start this process is to do what's called a discovery meeting with our firm, Chastain Wealth Management. It's a 90-minute meeting. A lot of people have likened it to a psychological profile or a life interview. Yes, we talk a little bit of investments, but it's 90 minutes of asking questions, everything from, how are your assets currently structured? Do you have a buy-sell agreement? Do you have any pets? Some people really want to do planning for their pets. So, that's just an example of how detailed we get to really know the person. And then once we know the person and we know what their desires are, I definitely want to do this, or I definitely don't want to do this. I have this cash flow. I don't have this cash flow. We take it through a review with our other professional partners, about, the estate planning experts, the life insurance experts, the asset protection experts, et cetera. And for free, we offer some solutions. Obviously, if you implement those solutions, we move forward with one of our professional partners like Kim or Jeremy. But it's really a great first tool, great first step to identify what you want and then to get some possible solutions. So please, if you're interested in all of this, please schedule one today. Just email Corey@chastainwealth.com and we will get you on our calendar to get that process started. Do we have any questions from the audience? Feel free to just hit the Q&A button on the Zoom, or if you want to hit me with the chat, if you'd like to articulate your question verbally, let me know as well.
Okay, it looks like we have a question from Matt for Jeremy. Can you explain the anticipated change in law with step up in basis and how that would affect my children if they would inherit my $3 million business? And it looks like there's $2 million in gains.
Yeah, great question, Matt. Thanks for asking. If there is going to be a repeal of the step up in basis now, so by default, there will be a carryover cost basis. What is one of the only ways to obtain a guaranteed step up in basis asset, if that does in fact happen? It would be to purchase life insurance inside of a trust, and that would create that step up in basis that you no longer would have based on the new proposed administration. So you would purchase life insurance inside of a trust equal to the amount. Great question.
Okay, let's see. It looks like we have one for Kim. Kim, this is from Jill. Do you need to worry if you're not close to meeting the tax exemption?
Jill, great question. And I actually get this a lot. Some of my clients actually laugh when I say the exemption is 11 million per person, right? That's $23 million. And so less than 0.5% of Americans are owing estate tax under the current regime. I will say though, in the early 90s or in the mid 90s, even we had a $600,000 exemption all the way through early 2000s, it went up to $1 million. So the numbers are always subject to change. Depending on who's in Congress, who's in control of our government, you know, that kind of swings. I have another client who calls it political football with the estate tax exemption. So certainly the Democrats like to see a lower exemption. Republicans typically like to see a higher exemption. So again, going back to the core purpose of estate planning is to pass your assets down intact for your family and pay as few as taxes as possible. So it's always worth having a conversation and thinking about it because we just don't know what's going to happen. And I'll be quiet in a minute here, but the Smith family just really didn't know what their winery was worth. I think mom was, or the adult children, I should say, were really shocked to find out that the valuation on their land and the winery business was north of 10 million when mom passed. So use the resources that are available to get a no-cost valuation. Talk to your CPA, talk to your advisors about what assets really are worth that you own.
Kim, is it safe to say that if the Smiths had if they'd taken advantage of the husband's exemption upon his death, that they would have owed no estate taxes?
I don't think that we would reduced it to zero, but it would have been reduced significantly. When husband died in 2008, we had a $2 million exemption. So let's say we were able to capture that rather than just wasting it and sending assets over to mom. We didn't have portability back then. So we would have preserved $2 million worth of net worth that could not been later taxed at wife's death. So probably a significant reduction. I think that if I ran the numbers, it would probably be less than $1 million in estate taxes due.
As opposed to the
3.4. Yeah.
Just by a meeting with
just by doing a more robust will for dad, we would have captured his exemption.
Great. Looks like we got a question as well from David. How late in the year can they pass these laws for 2021? Or is it safe to say it won't happen until 2022? Great question, David. And the answer is we don't know. They can, I think, Jeremy, you told me they talked about April, just going back to April. So anything done before April. But, these are politicians. So they can pretty much do, whatever they want. There's no law that says they couldn't make it, retroactive to a certain point. So, and it also kind of brings up a point, David, about, what are the solutions? Recognizing the income in this year, like for a business owner, one of the proposals was potentially recognizing more income this year. So it's taxed at the lower current rate in anticipation of 2022. There's no guarantee that that's going to work because they could make it retroactive. But, it's worth a shot, right? There, depending on your particular situation and, kind of what your desires are. Same thing with the, selling assets now to potentially recognize the capital gains rate. The only thing that we know for sure, and we don't really know this for sure, but that there's a decent chance the capital gains rate is going up. There's a really good chance income is going up for 2022. I can't imagine that they would put it past that. So, what's our best play here? What's our best guess? And that's to potentially recognize some income this year and potentially sell some assets this year. Again, depending on your particular circumstances, to see what to potentially avoid that.
Larren, I'm going to add one comment to that, and that's a perfect answer, David. From the experts in my industry that have continued to follow this and will, right now, it's this fall, essentially October, November, that Congress will vote on all these proposed changes. Right now, the only potential clawback or look back would be in the capital gains tax change. The experts in the industry that I'm with, they don't think that look back will actually happen for a number of reasons, probably over my head and behind the curtain because you're talking about DC and politics. But that's, kind of comforting to know that a lot of this is not necessarily looking to be clawed back. to 2021 at some point. So, there's a little bit of finger crossing. We'll see.
I'll add as well, at least from my perspective. I mean, we often see some kind of midnight planning, dawn of the new year changes in estate tax issues. So it will be negotiated and we will certainly follow it. Retroactive changes are not that common in our tax code. So we're just kind of waiting and seeing there what will actually happen. But I think that the key takeaway, and we've said it a couple of times, is to act now. Like, even if we don't see these changes, it makes sense to take a look at what you have in place now. We can go ahead and get trusts drafted and then get the valuations in place so that we know what worth we have. And if we want to actually make the transfers at the last minute in December, we can do that a lot easier than you calling somebody on December the 20th, because work just can't get done that quickly if the changes actually do come into place. So we're at early August now. We'll be watching kind of the negotiations pretty closely and see what gets passed, but it doesn't hurt to act with expediency.
That's right. And Kim, correct me if I'm wrong, but we know for sure in 2025 the exemption is going down. Period.
That's right. That's true. That is already part of our law. So some people in my field say maybe the path of least resistance in Congress is just to let that law slide, right? Just to leave it as it is, because we know in 4 short years, we're going to face a reduced exemption. So we have a little bit of wiggle room there. But on the other hand, the Democrats have wanted a lower exemption, since Obama was in office. And at this point, they have both houses. So it's more likely that would get passed now than it has been in a number of years.
Yeah, absolutely. So in that instance, it's $5 million per person that's going to happen in 2025. And a lot of folks that are, very successful, they don't necessarily think of themselves as, this is going to be relevant to me. A $22 million exemption, or in 2025, it'll be 10 million. But, as you go on, I had a client recently that I'm like, listen, you understand you're worth about $18 million. And he was like, what are you talking about? I was like, well, if you have this business, you have this, you both have $4 million life insurance policies, it's not in a trust, that all gets added into your estate. Sounds crazy, but getting to $10 million for some successful
pretty quick.
People,
it happens quicker than you think. Yes, that's exactly right.
Absolutely.
Yeah.
Great. So I think that is it for the questions. If anybody else has any questions, feel free to email me or Kim or Jeremy or Corey, and we will get back with you. We will make a copy of the presentation available to you as well for any other questions. But I would just wrap up with one last sort of point. It's what you deserve. Everybody on this call deserves this. I had a client recently who told me she had a conversation with her spouse, and she said, I'm so glad that we've really been able to live the life that we wanted to live the last 5 or 6 years. She retired a little bit early, but had a substantial amount of money. And I'm excited that we've been able to travel the world, do what we want to do, visit our children, make sure that we give our money, that our money transfers to the people and the organizations that we care about. But what I'm most excited about is that we've got another 10 to 20 years of that same type of life, right? And everybody here deserves that type of life. That really is what a financial plan and what we're talking about with this discovery meeting and making all these recommendations, that's really what it's all about. At the end of the day is that everybody here that's built their own wealth and that has that deserves to transfer that wealth and to protect it and to give it to the people and the institutions that they care about. So with that, we will close out. We thank you for joining us. We hope it was worth your time. And like I said, if you have any questions, feel free to email us, and everybody have a great rest of your week.
Thanks, everyone.
Thanks for having us,
everyone.
Larren.
Thanks, Larren. Take care.
Take care.